Hello and welcome to interest.co.nz. I'm David Hargreaves with another of our two-shot interviews, and I have with me today Tony Alexander, the BNZ's chief economist, and we're going to talk about various housing issues in relation to the LVR policy, etc., etc. How are you, Tony?
Oh, good. Yep. Good to get through winter, storms, earthquakes and things, and look forward to a bit of summer.
Exactly, and think about that housing market a bit. And your latest housing survey, done in conjunction with the Real Estate Institute, showed some fairly dramatic things. What did you make of it?
Yeah, I mean, what we got is we ask a range of questions, and one of them we've always asked is, are you seeing more or fewer first home buyers in the market? And whereas we've been averaging about a net 25% of agents on average each month saying more first home buyers, that fell to a net 41% saying fewer first home buyers in October, and for this most recent survey a net 78% saying first home buyers have disappeared. So the first home buyers have basically hopped out of the market, and I also asked the agents basically to say in words what they were saying, and again that's exactly what they said. The first home buyers have disappeared, and it's opened up the market for the investors, for foreign buyers. And so you still had in fact a net 6% of the agents saying we're seeing more investors in the market. So what's happening in the real estate market at the moment is very much a withdrawal of the first home buyers.
Now, was that more extreme than you expected?
It was definitely more of a pullback in interest from the FHBs, first home buyers, than I was expecting to be the case. And so that just leads me to think that there's probably a large shock element that's running through on in the minds of these people. These people have never made a big financial decision like this before, and so they're wary about maybe how much they can borrow, etc. It's a big decision to make. And we saw back in the global financial crisis 2008, 2009, bank lending continued in New Zealand, but with these stories about banks overseas collapsing, etc., a lot of the first home buyers back then, inexperienced people, were texting each other saying, oh look, banks aren't going to lend on mortgages any longer, she's all over for buying a house in New Zealand. So their level of knowledge of what is a normal sort of housing market mortgage situation is relatively low. I think they're just running scared at the moment. Eventually a lot of them will come back.
So you think that the sort of flight from the market that we're seeing at the moment, that will be reversed then? You're expecting that?
Yeah, it will be reversed. It's simply a matter of we're not really sure how long it's going to take. Now, by definition, they all come back again, because if previously you had a 10% deposit, now you need a 20% deposit, so you're out of the market now. Eventually you reach the 20% deposit, and as each month goes by, more and more of those first home buyers and investors who did not make the 20%, they make the 20%, and so then they're into the market. So over time, I think the Reserve Bank might have estimated after 8 years all of the impact of this has disappeared. I think it'll happen far more rapidly than that. The buyers come back in the market.
So, I was going to say, I mean, what's your kind of prognosis, if you like, for the next 6 months? What are you expecting to see with the housing market?
I think it's going to be a wee bit messy in terms of the indicators that we use. I think we'll start to see a return of the first home buyers very slowly. I think we'll definitely see a strengthening of the investor interest, because that's the pattern around the world. You've got continuing low interest rates in all countries out there. You've got central banks continuing to print money in some regards and maybe signalling further interest rate cuts across the Tasman. Investors are going either into equities or into property, and there's no reason for assuming we would be any different here in New Zealand. More Chinese money, emerging economy money generally, looking for a home. The shortage of property continuing in New Zealand. The migration numbers into boom territory almost as well. So I think we're going to have a lot of people realising that the market hasn't collapsed at all, that, oh right, this is again like late 08, 09, when we're not seeing house prices fall 40% in New Zealand simply because a significant event has happened. And that's what this is. It's a significant event. I think the data will be slightly messy, but then we're going to be basically ramping up again through 2014.
So perhaps a shock to come through, and then certainly next month's sale figures for the figures for November in terms of probably volumes.
Yep.
And then you think the volumes will pick up again early in the new year?
Yeah.
And you would still expect to see prices strengthen, do you think?
Prices go up. The fundamental for New Zealand hasn't fundamentally changed in that there is a shortage of property. So here's your stack of houses out there. Here's the number of people that need to occupy these houses. This stack here is increasing at an increasing rate because of the migration gains. The supply of housing, it's only growing relatively strongly. In fact, during the September quarter, the number of consents issued for new houses to be built in New Zealand fell by 3%. So this supply and demand imbalance increases, it gets worse. And the first home buyers who were going to become property owners have to stay property renters for a bit long, and that's what the investors can see. So the fundamental is there that unless something comes along and radically increases house supply in New Zealand in the near future, and nothing is going to come along, prices go up. End of story.
I mean, would you care to hazard a guess at the sort of rate of housing inflation we might see for the, up till Christmas next year, the 12 months up to next year? The Reserve Bank has talked about knocking it by 1 to 4%.
Yeah.
Take a midpoint, 2.5%. I mean, do you think that will happen? Where do you think it'll be?
Oh, so if you take 2.5% off whatever was otherwise going to be the case, so maybe you end up with a 10% average capital gain in Auckland. Maybe it's going to be similar down in Christchurch as well. The rest of the country, generally, but not exclusively, won't be that much. It takes time for those gains in Auckland and in Christchurch to spread to other centres. But generally, let's guess something like about 10%. But, I've never actually seen anybody with a model that accurately predicts house price increases. Best guess.
And then after that first 12 months, you'd expect the impact of the LVRs will kind of work its way through the market, and the market will kind of carry on as it would have done, do you think? Or?
Well, a year down the track from now, the LVR impact will be fading away by definition. The Reserve Bank has said that. It'll still be there, but it'll be fading away. The more significant new influence on the market will be the increasing interest rates, which we expect from about the middle of next year. Increasing interest rates, but also a potentially rapidly improving labour market in New Zealand, accelerating wages growth, the migration numbers even stronger. So just because somebody sees the interest rates going up doesn't mean the housing market stalls when you've got the pure economic fundamentals moving more and more in favour of people looking to upgrade their houses, looking to buy investment properties. This ball, I think, will keep rolling, and we've had the shock of the LVR. There's a bit more to roll through. But the fundamentals basically say with a potentially very strong New Zealand economy for maybe the next 3 years, the market generally keeps rising.
The BNZ has put back its forecast of when the first rise in the official cash rate might be till June. Are you taking a softer view now on interest rate rises, or are you still expecting some fairly aggressive interest rate rises over the next 12 months to 2 years? And what sort of scope?
Yeah, we delayed the increase largely because the firmness of the Kiwi dollar, and it's something the Reserve Bank has referred to as well, so just pushed it out a little bit. But the inflationary pressures are going to build in New Zealand in that we've already got an above average net percent of employers saying it's hard to get skilled and unskilled labour. The capacity utilisation rate, a stack of machinery being used as it were, is already above average. And this is before Christchurch gets cranking and Auckland house building gets going, and we really get new irrigation schemes out there in the dairy sector, all this sort of thing. So the inflationary pressures will build. For now, pretty much like everybody else out there, including the Reserve Bank, we forecast that the cash rate will rise about 2%. The risk is it rises more than that. We've been at this point in the interest rate cycle a number of times before, and what us economists tend to do is underestimate how much interest rates will rise. We always say, this time it's different. And by crikey, definitely I'm saying again, this time it's different. So maybe that means the cash rate doesn't peak at the old, 6.5 or 8.5% area. Maybe it could peak at 5.5. So our official view is 4.5 peak. I would run my numbers for people looking at borrowing money, assuming a 3% increase in mortgage rates, not just a 2%.
Do you have any feel for how prepared people are at the moment for higher interest rates? I mean, anecdotally, it seems that people are not kind of expecting it, and they've got very used to lower interest rates. So you do worry about how geared some people are. Yeah,
maybe not so much how geared, but how unprepared I think people will be for the rate rises, in that we've had low interest rates now in New Zealand since late 2008. You've got a whole grouping of people who think maybe this is the new normal. They see messages from overseas overseas, of growth downgrades, of central banks saying they're going to keep interest rates low for a long period of time. They've seen previous warnings that maybe you need to get into fixed interest rates prove not the best advice at times, and those who have stuck on floating will say, man, I'm just going to stay floating here on out. So I think there's probably not so much overgearing as such as a bit of complacency. And the thing to look for there will be, as interest rates rising, people saying they're only going to go up a little bit. The Reserve Bank isn't going to raise them a lot and cause a recession in the New Zealand economy. Yes, they will, if they think that's what it's going to take to get inflationary pressures eventually under control. It's not our forecast, but the risk is always on the upside over that interest rate cycle, and I don't see this time being any different.
So potentially some fairly shocked people out there.
I think there will be some shocked people who are just sitting there right now assuming, nah, they're not going to be able to raise these rates for ages because the rest of the world is still looking relatively woeful. Here in New Zealand, we've got the biggest construction project in our history just kicking underway at the moment. We've got continuing high commodity prices, a 2.3% equivalent boost to GDP from Fonterra dairy suppliers for this season, for instance. So a lot of positive factors that say our growth accelerates, unemployment rate comes down, wages growth accelerates, all these sort of things that add to inflation and eventually will cause concern for the Reserve Bank. Not now, but 12, 18, maybe 24 months down the track.
And this is the final thing. I mean, you've made mention in some of your weekly newsletters about the whole subject of young people, instead of becoming owner-occupiers of their first homes, actually increasingly seeking to rent those out. What do you think is going on there, and do you see this as a building, ongoing trend?
I think it will be a trend. I think back to myself in 1987 when I came back to New Zealand, saw house prices rising, and you feel it in your gut, the need to get a foot on the ladder. You become fearful of missing out on buying the sort of house you want because the prices are rising so rapidly. So you need to do something to basically get yourself in there and rising along with all the other boats. Now, if as a result of the new LVR rules, you're not going to be able to buy the true first home that you wanted, that doesn't mean that gut desire to get on the ladder has changed at all. I think you're going to be looking at something else, some other way of doing it. I think it's going to lead to a lot more people looking at inner city apartments in Auckland, predominantly we're talking about here, and people just looking at a lower price property they've got the deposit for, and they'll rent it out as an investment. They'll be hoping to make some capital gain, maybe some decent rental income, and build their deposit over time through a combination of the rental income and the capital gain, and then get the place they truly want, 1, 2, 3, 4, 5 years or whatever down the track. There are no numbers on this at the moment, and there will be no numbers in the future, in that, unlike Australia, we don't have data showing there are this many first home buyers out there are this many investors. But generally, I think that's the trend we're looking at for a lot of young people.
Okay, plenty to think about as always. Thank you very much, Tony Alexander. I was David Hargreaves for interest.co.nz.